On April 1, an open-ended scheme of mutual fund had 300 lakhs units outstanding with net assets value of 18.75. At the end of April, it issued 6 lakh units at opening NAV plus 2% load adjusted for dividend equalization. I'll briefly explain what this dividend equalization concept is. Okay, we'll do the question detailed discussion. I try to put a separate video on dividend equalization. Okay, anyways, at the end of the May, 3 lakh units were repurchased at opening NAV less 2% exit load adjust for dividend equalization. At the end of June, 70% of its available income was distributed. In respect of April-June quarter, the following additional information are available. Portfolio value appreciation 425.47 lakhs. Income for April, May and June given. You are required to calculate income available for distribution, issue price at the end of April, repurchase price at the end of May, and net assets value as on 30th June. Okay, this is a question that is being asked. Here there is a small concept, that is dividend equalization. Okay, which I will explain here briefly. Then we will try to solve the question. See, what is dividend equalization? I will tell you. See. What happens in open-ended scheme? I told you, in an open-ended scheme, okay, in open-ended mutual fund scheme, what happens? There is no restriction in the entry date or exit date, which means the fund will be open anyways you can invest in between also. For example, if I want to invest, see, this is assume this is 1/1/2025, okay, and to 1/12/2025. Assume this is calendar year 2025. Now here, see, I buy this investment. I assume someone, this is opening date. Assume this is opening date. Someone bought the mutual fund on 1st January 2025. This is existing member, existing unit holder. Okay, unit holder. And after some time, assume that after 6 months, assume 1st July 25, few more unit holders came. Few more unit holders, I call it as fresh unit holders or new unit holders. Now, you see what happened. This unit holder is holding the units throughout the year, and okay, the in between after 6 months, okay, few new unit holders purchase the unit. It is possible. Yes, it is possible because it is open-ended scheme. I told you, anyone can enter on any date. He can buy the new units of the mutual fund scheme. Now the point is, what is happening now? Assume during this entire 1 year period, assume the mutual fund okay, received an income of 50,000. The mutual fund received an income of 50,000. Now the point is, assume the old unit holders, existing unit holders are 1,000. Okay, 1,000 units, they are holding 1,000 units. New unit holders are only 200 units. New unit holders come into the picture after 6 months. Now the point is, when the dividend will be distributed at the end of the period, when dividend will be distributed out of 50,000, this 50,000 is a distributable income. The income which received, which the mutual fund received, this income should be distributed to the unit holders. Now what okay, it will happen. What it will happen really? 1,000 plus 200. Now, what will happen? 1,200 units. This 50,000 will be distributed at the end of the period to entire 1,200 units. Are you understanding? 50,000 divided by 1,200, which means 41.66 will be dividend. Okay, paid. The income per unit. This is the dividend per unit, which means the distribution will happen now of the entire 50,000 will be happening to entire 1,200 unit holders. But this is not fair, because 1,000 unit holders already they are holding, okay, more than 6 months more than what these 200 unit holders hold. Correct? Are you understanding? This is unfair. It is unfair to distribute, okay, 50,000 which is earned throughout the period to only to all the unit holders evenly. It is unfair, because this unit holders, assume that the 50,000 profit is clear. This out of this 50,000 income earned during the year, first 6 months assume it is 30,000. Second 6 months, second half, only 20,000 is earned by the mutual fund, which means, okay, this 20,000 can be distributed among entire 1,200 unit holders, but the first 30,000 which was earned during the first 6 months period, which only belongs to the initial unit holders, correct? It should be ideally, it should be divided by 1,000 units, but the dividend is being distributed, unfairly distributed. Hence, what we will do is that it's an accounting adjustment. The dividend equalization levy is an accounting adjustment, whereby, okay, the new investor existing, the new investor will be charged. The new investor who are coming to invest now, they will be charged with this levy. They will be charged with this levy, additional amount to make the compensation. How it will be now? How the charge will be, I'll explain. I don't go deep into this concept. It will take a lot of time. I'll briefly explain. See what they are saying. You came after 6 months, correct? Now, how dividend equalization levy will be happening, I'll just tell you, because after 6 months you are coming now. So, at the end of 6 months, assume the first 6 months period, I have a profit of 30,000 now. What is the profit? 30,000 is the income earned. Profit in the sense income earned by the mutual fund, divided by existing number of units. 1,000 units are there now. 30,000 divided by 30 it will give you 30 per unit. This I will charge, okay, from the new investor. This I will charge from the new investor to make good the, okay, losses made by the initial investor, which means 30 per unit will be the dividend equalization levy. How it is computed? This levy is computed. How it is computed now? Very simple. The, okay, income earned during the period for which the new investors are not there, unit holders, okay, income earned during the period divided by units outstanding till the date, which means when I am entering after 6 months, the new investor will enter. After 6 months, when new investor entering, on that day, the first 6 months, what is the income earned, I will see during the period, not till the period, right? The income earned divided by, okay, till the date, what is the unit outstanding, what is the total number of units outstanding, I will get income per unit. This I, okay, take it as compensation. This is called as dividend equalization. Now we see what happens in the question. Okay, first one by one we will see all the data given. Income available for distribution, which means what they are saying now, this is the portfolio value appreciation. 1st April, this is the situation. Okay, this is income earned in April, May, June is given. Totally at the end of the period, what is the income available for distribution? They are asking. See, the income available for distribution means, okay, you will have, you will include April income, May income as well as June income, and total what is the income pool available for distributing the unit holders. This we will see. This is the first segment they are asking. For that, you need to compute dividend equalization levy. Dividend equalization levy will be charged when the new investor, new units are issued. Very simple. Dividend equalization will be, it's a compensation, it will be charged by the from the new unit holders. And if there is any repurchasing, if there is any redemption, what will happen? The company has to, the mutual fund has to pay the dividend equalization levy. Are you understanding? When the company, when the mutual fund is issuing the units, it will collect dividend equalization levy, and when redemption is happening, it will, okay, pay the dividend equalization levy. Are you understanding? See what is happening. See, income from April, 300 lakhs units were outstanding, and April income is 22.95 na, correct? Yes, but this we need to see what is now the new unit holders will come, correct? You see, new unit holders are coming now. Here what they are saying, 1st April 300 lakhs units were outstanding, and this is the income for April, agreed? At the end of the April, it issued 6 lakh units. I told you, whenever it is issuing new units, it will collect dividend equalization levy. When it is collecting dividend equalization levy, tell me children, the income will increase or decrease? It will decrease or increase? it will collect from the investors, mutual fund house income will increase. Are you understanding? So what is happening on a per unit basis? How do you find dividend equalization levy? Very simple. The income is 22.95 na. This is the income earned for this period divided by units outstanding 300 lakhs. You do it, you get 0.075765 per unit. This is the levy I should charge per unit. I just calculated 30 per unit in our example na. Same way, this is the levy I will charge this. So 6 units issuing new units na, I will collect 0.0765 which comes to 0.4590, 22.95 I'll add to the income. This dividend equalization levy which I collect from the investors, I add the income, whatever I collected from them, I will add to the income pool which is available for distributing. After after collecting, if I distribute, it will be okay, fair. Are you understanding? How with all the numbers I can explain it on a different video. I don't want to take your time here discussing all those things. I will assume that you understood that is why I am discussing. Are you understanding? So very simple. If I am issuing new shares, issuing new units, dividend equalization, I will collect, I will pay, I will collect, and this collected amount it will get added to the income pool already which you have earned. 22.95 which I earned for income from April plus 0.459 which I collect from the new investors, I will get total income of 23.4090 and the total balance outstanding units will be 306. Are you all understanding? The rate will be same, per unit rate will be same. Now from this again you add income from May. You are adding income from May. 34.4250 is income earned in May. Upper totally 57.8340 will be total income pool. This will be divided by 306. You will get per unit. This is to be repaid for the at the end of the May. You have income after the May. At the end of May, what they are saying, there is redemption. The issued 6 lakh units in the end of April. At the end of April. At the end of May, what happens? 3 lakh units gets repurchased. 3 lakh units gets repurchased, which means I have to pay dividend equalization levy now. Earlier you collected dividend equalization levy. Now you have to pay dividend equalization levy. How much you will pay? So, see, 306 units outstanding. Total income is available for distribution 57.8340. On a per unit basis, 0.189 is the per unit value. This for new 3 units, 3 lakh units, I need to pay 0.189 as dividend equalization levy, which means 3 unit 0.189. I reduce it 0.567, I'll get 57.2670 for the 303 units. Are you understanding till now? This is that. Then add income from June. I told you this will be you will be deducting from the income available for distribution, which means, see, very simple. I have 57.267 and I have 303 units outstanding. Now if I multiply, if I divide it, I'll get per unit value as 0.189. Again, add income from June to that. This is up to May. You see, at the end of April you have earned some income, adjusted with dividend equalization levy. You collected and it became 23.409. Again you added 34.40 income from May. At the end of the May, again you repurchased 3 units by paying dividend equalization levy of 0.567. It came to 57.267. Are you all understanding? Now again you will add income from June to that. Till May you have adjusted. Now come to the June adjustment. You add income June. Whether you are redeeming or issuing any new units in the June, nothing you are doing. So you just add 45.4 income from June. Total comes to 102.713. Total units outstanding 303. Are you all understanding? This is the income available for distribution at the end of the June. What is this? This is the income available for distribution at the end of the June. And the question says specifically that at the end of the June, 70% of its available income was distribution, which means, see, they are asking at the end of the June, what is the income available for distribution? Dividend is paid, 70% of this is paid as dividend, 102.717 into 70%, 71.90 you pay out as dividend. Again, what is the balance income which is available for distribution? 30.8157. See, this is income available for distribution before 70% distribution. After distributing this 70%, still income available for distribution, further distribution, that is the meaning, is 30.8151. Are you understanding? And outstanding total number of units will be 303. So, first part of the solution stands answered. Income available for distribution. Okay. Next, issue price at the end of April. You see what happens. You have to issue, they are saying that they have issued 6 lakh units now. So 6 lakhs units, at what price they would have issued, this you need to find out. Okay, they are asking that. At the end of the April you are issuing 6 lakh units now. What would be the issue price? Then at the end of May, 3 lakh units are being repurchased. What would be the repurchase price? Next segment. So we will see issue price at the end of April, repurchase price at the end of May. 6 lakhs units you initially issued at the end of April, that we will find out. Then at the end of the May you are repurchasing, at what price you will repurchase. Are you all understanding? There is significance because issue price is the price which the investor will pay. Repurchase price, the price what you pay to repurchase back the units. Are you all understanding? Next, last segment, net assets value as on 30th June, end of the period. What is the value of net assets? We are going to find out. See, one by one we will see. Now, calculation of issue price at the end of April, very simple. Opening NAV I will consider as such and then I will adjust. See, issue price is nothing but, okay, issue price, I will tell you how issue price is to be computed. Issue price is nothing but, okay, NAV prevailing on that date. Issue price when you are calculating, NAV prevailing on that date you will consider anyway, that is the NAV you should pay. NAV the investor will pay ultimately, but apart from that there will be adjustment. NAV the investor will pay entry load is nothing but, okay, it is charged when initially the investors are buying the new units. Okay, so NAV plus entry load will be there. Now exit, this is entry load, I'll just entry load plus dividend equalization levy. See, this dividend equalization levy, okay, will always be added to the NAV, which will be added to the NAV. Concept, logic and all I will discuss in a separate video, but here you should not get confused. See, entry load will be added, exit load will be reduced from the NAV. This is NAV prevailing on that date plus entry load plus dividend equalization levy. This is issue price. Repurchasing, when you are repurchasing, the fund house, okay, will redeem you the NAV, will give you back the NAV, but apart from that it will charge some exit load. When mutual fund house charges the exit load, your NAV will get reduced or increased. Okay, the NAV, see what I am saying, this is exit load, it will reduce exit load. See here, the investor will need to pay. If investor needs to pay, he also needs to pay entry load. Are you all understanding? Here in case of repurchase or redemption, what will happen? Units will be redeemed back, which means who will pay the money? The fund house will pay the money. When mutual fund is paying money, okay, it will give you NAV, but it will reduce the exit load. Then only it is something like commission. Okay, it is something like commission and it will get reduced. But dividend equalization levy, of course, it will pay. It needs to pay to compensate, okay, the investor, unit holders. See, so you tell me issue price how to compute? NAV plus entry load plus dividend equalization levy. Repurchase price how you compute? NAV minus exit load plus dividend equalization levy. Are you all understanding? Okay, here solution given, please see. Opening NAV 18.750, which means April end NAV only you should consider. What is the April end NAV? Please see the question. Okay, April end, yes, 18.75 is there. Okay, NAV, opening NAV, yes, 18.75. Now, if the 18.75 is there, and this NAV you will add entry load of 2%. You will add I told you here NAV plus entry load, you will add 2% of entry load and it comes to 19.175. Then add a dividend equalization levy 0.0765 you will get 19.2015. Are you understanding? Calculation of repurchase price, opening NAV you have 18.750 less exit load, you have to reduce the exit load 0.375, you will get 18.375, add dividend equalization levy paid on issue price, which means 0.189, 18.564. It only catches entry load, exit load, entry load and exit load you will compute on NAV, you will calculate. This percentage will be applied on the NAV, but not NAV plus dividend equalization levy. Are you understanding? Dividend equalization levy is an accounting entry and charges separately, okay, irrespective of the NAV. Are you understanding? Okay, and the entry load or exit load you should apply on NAV and not NAV including dividend equalization levy. Okay, this applied purely on the NAV. Then you add or subtract this exit load, then you add a dividend equalization levy. This will be the number 18.564 is the repurchase price. Are you understanding? Now closing NAV, very simple. They have asked last segment, they asked closing NAV. Yeah? Now opening net assets value 18.75 into 300. You got this opening NAV, right? Portfolio value appreciated. Portfolio value appreciated. From here, this was the value. Opening NAV given into number of units given. Total opening net assets given. Yes. Appreciation portfolio value 425.47 given. Issue of fresh units, at what price it is issued, 19. Whenever they say issue, this will be the proceeds collected. Are you understanding? Including, after adjusting entry load and the dividend equalization, you should consider 19.2015. This is they have done. Income received, issue of fresh proceeds, this amount. Then income received, okay, income received for the April, May, June. Up to June only they are asking the NAV at the end of June, so you will consider all the three. Total comes to this much. Unit repurchased, here I repurchase price only I will consider, which is 18.5674. Are you all understanding? Okay, repurchase 3 into 18.564, 55.72 plus minus income distributed. Out of this, I distributed how much? I already discussed now. 70% of my income which earned for a period of 3 months, I distributed. How much? In the first step itself, I computed that is 71.9019, which I already distributed. Now that I will consider. Okay, and get the total value, closing net assets value as 6140.9101 divided by 303 lakhs units. Why? Initially 300 lakhs, 6 lakhs units issued, 306 minus 303 outstanding number of units, closing NAV as on 30th June. I get it 20.267. Very, very important question. Okay, mark it as important. And detailed concept regarding this dividend equalization levy, I will make a separate video anyway. Now, take question number 21. There are two mutual funds, D mutual fund and K mutual fund, each having close-ended equity schemes. Okay, NAV as on 31/12/2014 of equity shares of D mutual fund limited is 70.71, consisting 99% of equity and remaining 1% as cash balance. And that of K mutual fund is 62.7. This is NAV. Okay, this is NAV. 62.5 consisting 96% equity and balance in cash. See, I will tell you what it is. NAV, you know already that NAV is nothing but NAV per unit is nothing but total net assets value divided by number of units outstanding. In numerator total net assets value will already have, okay, equity portion, which is the market investment portion, plus closing cash portion. Are you understanding? There will be some portion of the cash which is not invested, and there will be balance which already is invested. Are you all understanding what I am trying to say? See, very simple. If the fund initially has 100 rupees, 85 rupees it has invested in cash, invested in equities. Assume in demat it will be lying, 85 will be in demat account, and the cash balance, the balance 15 rupees will be there, which is available for investment. It has not done any investment, which is available as cash. Are you all understanding what I am trying to say? By the NAV per unit 62.5 and 70.7, like just like total NAV, okay, on a per unit basis they are saying that out of the 62.5, 1%, 96% is equity, which is invested in equity shares, and 4% is not in, it is available as cash. We will find out what this is, why this is relevant, all these things for computing beta, and for all this this is relevant. We will compute, no issue. Okay, they are given that the segregation you should understand. Then following are the other informations: equity scheme, Sharpe ratio given for D mutual fund and K mutual fund, Trainer ratio given, standard deviation also given for both these schemes. Okay, There is no change in portfolios during the next month and the annual average cost is 3 per unit for the schemes of both the mutual funds. If share market goes down by 5% within a month, calculate expected NAV after a month for the schemes of both mutual funds. See, share market goes by 5% within a month, which means today you invested, tomorrow what happens after 1 month, the share market is dropping by 5%. The Nifty, okay, share market means Nifty, index, anything, Sensex, I call it. It is dropping by 5%. What will happen to your portfolio? Are you listening? This we need to compute. Okay, for after a month for the schemes of all. For calculation, consider 12 months in a year. Ignore the number of days for particular month. Which means 30 we will consider month. In monthly basis we will consider. Okay, 1 by 12 or 2 by 12, whatever it is, right? We will consider. See, very simple and straightforward issue only. Here, okay, what is happening? You need to say. I am first working note. First part of the solution. We are trying to segregate. Okay, the cash portion, equity portion and cash portion, equity element and cash element, they have already given for a due mutual fund, NAV is 70.71. Here percentage of equity is 99%. I told you on a total basis also you can segregate. For example, total basis 100 is the total net assets. Here, okay, you have 99% equity and 1% cash. Now 99 rupees is equity, 1 rupee is cash. Like that, NAV per unit 70.71 and a per unit basis I am segregating. Very simple. Equity element in this NAV is 70. Okay, per unit. 0.71 per unit is cash element. Are you all understanding? Same way for K mutual fund also I am segregating. They have given the percentage, a percentage of equity and percentage of cash. Okay, I am segregating and I get 60 rupees as percentage. This 62.5 consists of two components. 62.5. Okay, this is 60 is equity component, 2.5 is cash component. I'm just segregating the first step, equity component and cash component, so that, okay, see what is the importance, now what is the significance of separating is that when the share market goes down by 5%, when the Nifty changes, your portfolio, equity portfolio value will change. But cash position will not change. Are you listening what I am trying to say? This will only impact the equity share portion. Demat account will only get affected, not your bank account. Yeah, are you understanding? Same way, see here. Now, calculation of beta. Why is this relevant? Now, I will tell you. See, very simple. You have been given Sharpe ratio as well as Trainer ratio. Sharpe ratio is nothing but, okay, return, required rate of return, average rate of return. This I call it as mean return. Okay, R bar minus RF divided by Sharpe ratio, na? So standard deviation, which means this is Sharpe ratio, this is SR. Sharpe ratio, okay, tries to find what is the return which you earned over and above the risk-free rate of return. This is RF. So what is R bar minus RF? Na? Expected return, mean return over and above the risk-free rate of return. Are you listening? Which means this is the additional return which you earn for every measure of risk. The denominator is standard deviation, which means for given level of risk, what is the return, extra return over and above the risk-free rate of return I earn. This is what Sharpe ratio tries to identify. What is the difference between Sharpe ratio and Trainer? This is Sharpe ratio. What is Trainer ratio? Trainer ratio is nothing but, okay, R bar, okay, minus RF. The numerator will be ditto same, no change in numerator, but in denominator the measure of risk from standard deviation changes to beta. Trainer ratio, okay, this is also called as reward to volatility ratio. This is reward to volatility ratio. This is also called as reward to volatility ratio. This is reward to variability ratio. This is reward to volatility. All this we will study later. And the portfolio management chapter I would cover, no issues here. Trainer ratio, okay, expected return minus risk-free rate of return for given level of risk. Risk is measured using beta, and trainer ratio it is measured using beta. That is the only change. Okay. Now, what is common in these two ratios? R numerator is common, which means the R bar expected return minus risk-free rate of return is common, na? Okay, that we will use and solve solution. See here, very simple. Sharpe ratio given as 2, you equate it. You know what is the standard deviation given in the question itself, but you don't know the numerator. Okay, leave it as such. Leave it as such. Expected rate of return R bar minus RF. You keep it like this. Are you all understanding? 2 is equal. So what I will get, R bar minus RF, or expected return minus risk-free return, I will get it as 22.5. This I can substitute in the trainer ratio and find out the beta as the balancing number. Are you all understanding? Which means trainer ratio, Sharpe ratio given as 11.25, standard deviation given as 11.25, and I substitute this in Sharpe ratio and found out R bar minus RF. Then I substitute, okay, here standard deviation here and find out, okay, what is that for K mutual fund. See, very simple. Yes, I substitute this R bar minus RF in finding beta. This trainer ratio I substitute and find out beta. Trainer ratio here, trainer ratio given as 15. Okay, can you see this? 15, trainer ratio given as 15. Given as 15, and I'll use this and substitute. See, 15 is equal to 22.5 divided by beta. I'll find the beta of D mutual fund. This is the beta of D mutual fund. 22.5 divided by 15, I get as 1.5. Are you all understanding? Same way for K mutual fund also. Sharpe ratio given as 3.3. Sharpe ratio given as 3.3. Okay, then I'll use and substitute and get R bar minus RF, which is also expected return. ER na expected return, which I call it as mean return, R bar. Are you all understanding? So the R bar minus RF I get as 16.5. This 16.5 I substitute in the trainer ratio and get the beta value as 1.1. Same thing, 16.5 divided by beta. 15 is equal to 16.5. So beta is equal to 16.5 divided by 15. I get 1.1 as beta. Now I got beta for these two stocks. Are you understanding? Now I will understand how much my portfolio value appreciates or depreciates with regards to the index. What they are saying, at the end of the month, what happens? Okay, the market, share market goes down by 5%, which means the share market drops to 5%. Now market goes down by 5%. Index in Nifty Sensex is going down by 5%. Beta is a measure. What is beta? Beta is nothing but change in portfolio return, or say change in security return with regards to change in market return, which means market changes by 5%. What is the change in portfolio? Okay, this is what is captured by beta, which means beta is 1.5. If market goes by 5%, okay, your portfolio value or your share position value will change by 5 into 1.5, 7.5%. It will drop. Okay, are you all understanding what I'm trying to say? Market goes down by 5%. Beta is 1.5 na, more risky than market. Beta is 1. So 1.5 means, okay, 1.5 times more risky than market na, which means 5% if it is go down index, your portfolio will go down by 7.5%. Understand, your portfolio in the sense equity portfolio. This is not the cash position. Okay, cash position, now the amount which is not invested in equity. So, which you have invested in equity in your demat, okay, the portfolio value will get reduced to 7.5%. Here also 5%, 5.5%, because here beta is 1.1. It will reduce by 5.5% for both this one. So, balance of cash after 1 month, see. Your NAV after, you want to compute ultimately NAV after 1 month. For that you need two component, equity component, cash component. Equity component, what will be the impact? We just saw 7.5% it will drop. D mutual fund, K mutual fund will drop to 5.5%. Are you understanding what I am trying to say? Now cash balance, opening cash, which means for D mutual fund it was 0.79, and expenses per month 0.025, which means annual expenses given in the question. You see 3 per unit. Okay, this is average cost na annual cost. If you 3 divided by 12, 1 month na, so 3 divided by 12, 0.25. Okay, this will be the expenses per month. So this month expense will be 0.25 per unit basis. I reduced. So cash initially was 0.79 minus 0.25. I get 0.46 for D mutual fund, and for K mutual fund, okay, the cash in hand was 2.5 minus 0.25. I reduce it. I get the cash balance of 2.25. After 1 month, what happens? You tell me. Okay, the 70 was the NAV. You see here what happened. Okay. Yes, 70 here, 70.79. I told you, you distributed, you segregated, and equity value equity component comes to 70 and 60. Are you understanding? Initially we segregated the equity component and cash component. equity component 70 and 60 is there per unit basis. This 70 equity component, I told you, it will drop to 7.5%. Take your calculator, 100 minus 7.5 percentage, which means how much is that? 92.5 percentage. Upper 70 was the opening equity component value into, it dropped by 7.5 percentage, which means 70 into 92.5 percentage, 64.75. Are you understanding? 60 was for K mutual fund. It dropped to 5.5%. Beta was 1.1. We calculated now 5.5%, which means 94.5%. 60 into 94.5 percentage, you are getting 56.7. Are you all understanding? This is the value of equity component. Come to cash balance, you already computed from this working note 0.46 and 2.25. Okay, total net assets per unit, net assets value per unit will get as 65.21 and 58.95. Are you all understanding how to solve this question? This question is very, very important. Mark it as important. Very unique type of question. Nothing big, just applying the concept and solving this. Okay, next take question number 22. A&P plan, a hedge fund, currently has assets of 20 crores. CAX, the manager of fund, charges fee of 0.10% of portfolio asset. In addition to it, he charges incentive fees of 2%. The incentive will be linked to gross return each year in excess of the portfolio maximum value since the inception of fund. The maximum value of the fund achieved so far since the inception of fund about 1.5 years ago was 21 crores. Okay. You are required to compute the fee payable to Mr. CAX if return on the mutual fund this year turns out to be 29%, 4.5%, minus 1.8%. 3 cases given. What will be the fund manager fees? Okay, with varying returns. See, very simple. This scheme offers the fund manager 2 kinds of return. One is the fees. One is the fixed fee. Another is the variable fees. Now, how is the variable fee structured? See, this is a maximum return. See, fixed fee, yes, 0.1% of the portfolio. This 0.1% of the portfolio, 0.1% of the portfolio is fixed fee. Now, variable fee, how they have structured? Okay, see what they are saying. The incentive fees, variable fees is 2%. Over and above the maximum portfolio value since the inception it achieved, which means assume this this variable fees will be 2%, but not on the overall value. What they are saying, the max value which the fund achieved. See, I'll tell you. If the return, current year return is over and above the max value, assume the max value achieved before 2 years. The fund achieved a maximum portfolio value of 21 crores in this question, right? But if see, the current year if portfolio value is 25 crore, which means extra 4 crore is there na. For this 4 crore, the incentive fees will be charged, which means the portfolio value which appreciates, okay, over and above the maximum value which appreciated since the inception. Since the inception, the maximum value will be given in the question, 21 given in the question. Assume if tomorrow the portfolio value appreciates to 25 crores, then on the additional 4 crores, you will get additional 2% for your extra hard work. Are you understanding? Like this, you should understand. Now, see, if return is 29%, what happens? You tell me, children. See, fixed value is 0.1% of 20 crore. 20 crore my base value into 0.1%. I get a fees of 2 lakhs. This is fixed fee. Irrespective of what happens in the return, I will earn this fixed fee. New fund value, initially you had 20 crore, correct? It has achieved 29% growth, means 129%. How much is that? 20 crore into 1.29 or 129%, 25.8 crore. Which means, you tell me, children, 25.8 crore, it is exceeding the maximum limit of 21 crores, which means 21 over and above the 21 crore, 4.8 crore is the excess value of best achieved, which means 25.8 crore minus 21 crore, 4.8 crore is the excess value. Now, out of this, the variable charge will be there. The excess portion multiplied by 2%, you will get the variable portion, 9,60,000. So, 2 lakhs plus 9,60,000 fixed plus variable, total fees, okay, fund management fees is 11,60,000 in case 1. Come to case 2, what happens? Fixed fees will remain same. New fund value 4.5% it appreciated na. So 20 crore into 1.045, how much is that? Okay, 20.9 crore. Whether it is exceeding the 21 crore earlier maximum return or no, it is not exceeding. Hence, there will be no variable portion, 2% of nil. It is not at all exceeding. Only when it is exceeding, you will be charged, you will be earning 2% of the balance, correct? But so no, nothing is being earned, so 2 lakh will be the incentive. Okay, this question is very important. Why? Because this question is being asked in your elective paper also, AFM segment, elective paper also, they are multidisciplinary case study questions. These type of questions are coming. Okay, that you should remember. Very simple and straightforward only, but you should remember this question is being tested. Now, last minus 1.8%. Anyhow, 1.8% only you will earn fixed return. Okay, no incentive fee. Only fixed fees of 2 lakhs will be paid. In case B also, only fixed fee will be paid. Okay. Last question, question number 23. Miss Sunidhi is working with an MNC at Mumbai. This is also very, very important. Regularly asked every 3 or 4 attempts, they are asking this question. Miss Sunidhi is working with an MNC at Mumbai. She is well versed with the portfolio management techniques and wants to test one of the techniques on an equity fund she has constructed. Compare the gains and losses from the technique with those on a passive buy and hold strategy. The fund consists of equities only and the ending NAV of the fund to be constructed for the last 10 months are given below. Okay. So December to September they have given, past 10 months they have given. Assume Sunidhi has invested notional amount of 2 lakhs equally in the equity fund and the conservative portfolio bond in the beginning of December 2008, and the total portfolio was being rebalanced each time the NAV of the fund increased or decreased by 15%. This you need to remember. This is a threshold. Okay, only when the 15% is breached, NAV of 15% is breached, then only you need to rebalance. Okay, otherwise you should ignore. Next, you are required to determine the value of the portfolio for each level of NAV following the constant ratio plan. Very simple. See, there are few strategies relating to portfolios. I call it as portfolio rebalancing strategy. Okay, see what happens here. Passive buy and hold. There's passive strategy and active strategy. Passive strategy, active strategy. Passive strategy is simple buy and hold strategy. This is nothing but buy and hold strategy, which means you buy the security today. If you are investing for 10 years, forget about your investment. Today buy for long term and forget about investment. Don't keep on buying and selling. Okay, all the cost you can save and just simply buy and hold. This is one type of strategy. This is also called as passive strategy. Why? Because you are not being active in buying and selling. This is passive strategy. Active strategy, okay, the constant insurance plan is there, which is of course not given in study material, but we used to cover in the class one of the question. Okay, there is one insurance plans based strategy. Here I am not discussing that strategy. I am just discussing the the balancing strategy, which is given in the question. Yes, constant ratio plan. What is this constant ratio plan? CRP. Okay, very simple. What I will do now? Okay, I assume today I invested 2 lakh rupees. I manage the risk by investing in equal proportion. Assume the proportion should be constant. The proportion will be given in the question. Okay, mostly the proportion will be 50-50. Okay, in this question and question. The question may change the proportion also. It may give you 60% equity, 40% debt. The debt and equity proportion may even vary. In this question, it is 50-50%, which means equal proportion I maintain. Okay, this is the constant ratio. Upper ratio is 1:1. I should maintain at all times this ratio, which means 2 lakh rupees I have for investment. So 1 lakh rupees I invest in equity shares. Okay, balance 1 lakh I invest in conservative bond or risk-free asset. Bonds or risk-free asset. This is less risky or no risk assets. Are you understanding what I am trying to say? Government of India bonds, I invest 1 lakh rupees and I invest 1 lakh rupees. The bond value will not keep on fluctuating. Are you understanding? The capital value, bond value will remain the same, 1 lakh. Okay, here equity shares value will keep on fluctuating. Are you understanding what I am trying to say? Whenever the equity shares value is fluctuating, okay, I will rebalance my portfolio. Very simple. You have 2 lakh rupees. You initially put 1 lakh, 1 lakh. Now what happened? Suppose the equity value reduced by 25%. Are you all understanding? If the share market drops by 25%, which means equity value, portfolio value reduced by 25%, what will happen to 1 lakh? This will become 75,000. Equity value will be 75,000. Debt value will be still 1 lakh. I told you, na, it will not change. It is assumed to be risk free, which means it will not change. You tell me, children, what happened? 1 lakh, if 25% is the drop, okay, in value, the revised value of the equity in your portfolio will be 75,000, and the 1 lakh bond value will be how much? It will say 1 lakh 75,000. Now the point is, okay, they will give you threshold limit when to balance the portfolio. Are you understanding? They will tell that if this is breaching, this much is threshold limit is crossed. See, if I say the threshold is 2%, if my price increases or reduced by 2%, you balance the portfolio. Na? Every day you need to balance, every single day you need to balance, because market itself, share market itself, 2% up and down, every day it can fluctuate. Are you understanding? So what I say is that I won't, rebalance the portfolio every day, but I rebalance on a constant interval. I keep some threshold. I say that if my portfolio, equity value of the portfolio is changing by 10% up and down, okay, if 100 rupees becomes 110, or if it becomes 10% 90 rupees, then I will make some rebalancing. Are you all understanding? Threshold will be given in the question. Again, so assume 10% is there. Now 25% there is drop in equity value. I need to rebalance. Now how I will rebalance? Very simple. 75,000 is the amount. 1 lakh is the amount. Now I simply add this total amount. Up a total value of my portfolio. Again, I need to rebalance. Up a debt value 1 lakh plus equity value 75,000. Total comes to 1 lakh 75,000. Now this 1 lakh 75,000. What is my strategy? 50%. 1:1 is my ratio. I told you, na. I again segregate that using 1:1. Up 1 lakh 75,000 divided by 2. Okay, I again 87,000. Make it even. Make it even. Okay, why the strategy is very beautiful, I'll explain. 87,500 and 87,500. Are you all understanding what it is? Okay, now you have rebalanced. You have made it 50-50. Now to make the value as 87,500, what do you need to do? Earlier you had value of 75,000. Now you are adding how much? 12,500. Are you all understanding? So 75,000. Now you are adding 12,500 here. From 1 lakh rupees debt value, the debt value should be reduced to 85,500, the closing balance, which means you will reduce here 12,500. Are you all understanding? To put it simply, what the rebalancing effectively does, na? From 1 lakh rupees, you are taking 12,500 and moving to equity. You are taking the money from bonds and putting the money into equity. 1 lakh rupees, you are taking the money from bond and adding this money, okay, to equity. It will ensure fairness. You will see what it is, why it is very important. I will tell you. Beautiful concept, because see, the 1 lakh you are taking 12,500, na? You are adding. Sir, why should I add? Na? Very simple. See, your share price assume was 100 rupees. Now it dropped to 75 rupees. That's why if you are holding, assume 1000 shares, it became 75,000, na? Which means from 100 rupees, the share price dropped to 75, na? Whenever the share price is dropping, it is ideal to purchase more shares. It will be undervalued, na? It will be, you need to SIP schemes, have you seen? Okay, when the share price is reducing, you will add more, you will buy more shares. When the share price is increasing, you will automatically, sell the shares and buy bonds. Are you understanding? This will ensure purchase of undervalued asset and sale of overvalued assets automatically, so that you are balancing your portfolio. Okay, this is a beautiful strategy. Are you understanding? This is active strategy. Why? Because you have to keep an eye on the market price. Whenever there is fluctuation over and above your desired value, you make the changes and then balance the portfolio. Listening, so this strategy ensures that you keep on buying undervalued security and keep on selling overvalued security in regular intervals, and try to balance your bond portfolio as well as equity portfolio. This is the issue, right? We will solve the question, you will understand. Okay, see what happens in case of share price. I told you share price is giving NAV. What is share price in case of equity is NAV in case of mutual funds, nothing. Okay, see here what they are saying. Constant ratio plan. Initially you tell me notionally you had 2 lakhs, that is why I took 2 lakhs as example so that you can easily relate. So 1 lakh conservative portfolio, which is nothing but GOI bonds, Government of India bonds. I invest 1 lakh rupees, 1 lakh rupees. You had 200 lakh, 2 lakh rupees, 1 lakh and 1 lakh I invested. Total value of portfolio 2 lakhs. Now, out of this 2 lakhs amount, number of units in aggressive portfolio alone you will consider, because see, which is conservative portfolio, na bond, Government of India bond will value will not change, I told you. So which means 1 lakh rupees you invested. Now this 1 lakh divided by prevailing NAV on that date. What is the NAV? Please tell me. First initial starting date NAV is 40. Are you understanding? The amount of money you have 1 lakh divided by NAV prevailing on that date will give you what is that? Will give you number of units purchased in the scheme. Up of 1 lakh divided by 40, 2500 is the initial units I purchase in the equity based scheme. Are you all understanding? Now, next to come to changes. First 40 rupees it was in December 2008. From 40 rupees it changed to 25 rupees. First you see how much is the percentage change, because it is relevant, because if the change is only more than 15%, they are asking you to compute. Are you all understanding what I am trying to say? Only if the change is over and above 15%, you need to decide whether you need to rebalance the portfolio. Otherwise, if the change is not up to 15%, you should not rebalance. You tell me, children. From 40 NAV, it dropped to 25. How much is that? Difference is 15 divided by 40. What is the percentage drop in price? NAV? Okay, 37.5%. Up 37.5. More than 15%? Yes. You will rebalance? Yes. So what I do? NAV 25 rupees. 2500 units were outstanding. 2500 units were outstanding. Okay, NAV 25 rupees is the new NAV. So 2500 into 25. How much is the value? 62,500. Which means my equity portfolio value from 1 lakh dropped to 62,500. Bond portfolio value will remain same. Will I balance? Yes. How should I balance? Again make it to 50-50. Again make it to 50-50. Now you will find out the total money. 1 lakh plus 62,500. 1 lakh 62,500. This 1 lakh 62,500 divided by 2. Which means you split it half, 50-50, 81,250. Okay, this 81,250, 81,250. After rebalancing, this will be the new amount. Okay, you will be shifting to equity and debt, which means effectively you take from 1 lakh rupees, you take 18,750 from here and you invest 18,750 in equity portfolio. Are you all understanding? Equity shares price, NAV is getting reduced. Now increase the equity exposure. Okay, and reduce the bond exposure. Okay, so 2500 units you will now. Originally you had 2500 units. You will sell units, buy units, you will buy more units. Are you understanding? Then only you can increase the equity exposure. Just now I told you. So you will buy equity units. How much you need to buy? You need to buy, okay, value. How much value first you need to see? First 1 lakh rupees I will take from bond minus 81,250. How much is the amount? 18,750. This 18,750 I am allocating to additional to equity. At what price you will allocate? Respective NAV. This is the amount. 18,750 is the amount I need to put it in equity. At what price you can buy NAV? New units of mutual fund at 25 rupees NAV divided by 25. How much is that? 750. You will buy. What is the strategy? Buy 750 units, which means originally 2,500 units you had. Okay, since your equity portfolio value get reduced, 750 you will buy additional 750 units and make it to 3250. This is closing balance of equity units after rebalancing. Come to next stage. What happened next? December, January over. Now come to February. February, what happened? The NAV changes from 25 to 36. You tell me how much is the change? 11 rupees divided by 25. It is increasing by 44%. It is increasing. Here it is decreasing. Here it is increasing by 44%. Now you tell me, children, whether you will rebalance or you will not rebalance in this month. Yes, I will rebalance because threshold is 15%. It is crossing 15%, 44%. Hence, I will rebalance. Now, how will I rebalance? Very simple. Apply the respective amount. Very simple. 81,250 debt value will remain same. Are you all understanding? equity value will be increased by 44%. Na? So 81,250, okay, 81,250. The equity value, very simple, 3250 outstanding units were there into 36. Just do 3250 into 36. How much is that? 1,70,000. You need to verify. So this, whether the total comes to 1,98,250. Whether you rebalance, yes, because the change is 44% extra. So you will rebalance. So 1,98,250 divided by 2 divided by 2. You will rebalance and make it to 99,125 in debt, 99,125 in equity. Now tell me, children, in this case, when equity value is increasing, you will sell equity, yeah? Okay, buy equity, yeah? You will sell equity. Equity value was 1,17,000. Okay, new equity value to be made 99,125, which means you will sell equity portion and buy bond value. Are you understanding? Bond you will buy from 81,250, it increased to 99,125, which means what do you do? I need to sell. How much value of this I need to sell? Very simple, 1,17,000 minus 99,125. This is the additional amount, 17,875 rupees. Okay, worth of equity I need to sell. So if you want to sell, if you want the amount to be realized as 17,875, how many units I need to sell? 17,875 divided by 36, prevailing NAV, divided by 36 or 36. How much is that? 496.53, 52753 rounded off. Okay. Are you all understanding? So you will get balance 3250 minus 496.53, you will get 2753.47. Are you all understanding till now? This is the closing balance of units after rebalancing. Next, see, 1 or 2 adjustments I will do. Same way again and again you should continue. There is nothing to be discussed. Okay, next step, March first step, whether you will rebalance, just to see the price adjustment, 36 and 32. Okay, 32. From 36, now price is dropping or increasing or dropping. It went to 32. Up 4 is the change divided by 36. From where it changed? 4 divided by 36, 11.11%. This is 11.11%. Whether you will make any rebalancing or not. Will you rebalance your portfolio? No, absolutely no. This is very, very important adjustment, which means the price is changing. Yes, I agree that the price is changed from 36 to 32, but I don't need it to do any rebalancing because the threshold limit is 15%. Otherwise, every day you need to change. Yeah? The threshold is 15%. It is not breaching the threshold, hence you will not make any changes. The portfolio value will remain same, but the 99,125 will change because the value is changing. Nah? See, very simple. How many units outstanding? 2753.47. Are you all understanding? So new value will be 32. The equity portion will be valued at 32 na, per unit na. Apo 2753.47 into what is the new value? 32. How much is that? 88,111. This will be the new value. Total is 187. But whether I need to rebalance, nothing needs to be done. So the same outstanding remains here also. There is no rebalancing done after this period. Are you all understanding? Now, next to change 38. They have given April 2009 the price changes to increase or decrease or increase. How much is increasing? 6 rupees it is increasing from 32. 6 divided by 32, it is 18.75 okay, percentage, which means definitely you should rebalance. I will explain this rebalancing. All the others will remain same, ditto same. You should keep solving. Okay, see here, you practice here. Okay, 38 is there. You tell me whether it increase yes. Whether any rebalancing required? Yes. But on 38, what is the value of equity? See, what is the outstanding? Outstanding units 2753.47 into at what price you will value as of today? 38 before rebalancing. 38 into 38. How much is that? 104,631.86. This is the equity value. This is the debt value. Rebalancing total is 203,756. Rebalancing required? Yes. The 203,756 divided by 2, 1,01,878 and 1,01,878. Now, what is the strategy? Sell 72.46. How did you get this 72.46? Very simple. Now, equity value was 104,631.86. Revised equity value is 101,878. The differential amount is how much? 104,631.86 minus 101,878. How much is that? 2753.86 divided by this NAV 38. How much is that? 72.46. These many units you will sell and the closing units will change accordingly. Are you all comfortable? Like this, you solve for 37, 42, 43 and 50. Okay, the closing units balance you will get. Anyway, closing balance of the equity units will be 2359.29. This 2359.29 into will be valued at what? Closing NAV as of September 2009. 52 is the closing NAV. Are you all understanding? So 2359.29 into 52, how much is that? Tell me, children. This is 122,683. This is what is the value. 122,683 is the value, and debt value, closing value is this much. Total portfolio value comes to 2,40,647 using the active strategy, buy and hold strategy. This is active. This is not buy and hold strategy. This is active strategy, portfolio rebalancing strategy. Okay, this is the value. Now, tell me, children, forget about this. If I don't go for rebalancing option, what will be the value? So if there is no rebalancing, in this case, what happens? Okay, 2 lakhs was the notional amount. Agreed? This 2 lakhs you would have invested at opening NAV. What was the opening NAV? Of 40 rupees. Are you all understanding? So 40 rupees you would have invested the entire 2 lakhs. You don't need to put the amount in debt as well as equity. There is no segregation involved. Entire 2 lakhs will go for equity, and it will be trading at 40. The NAV would be 40. Up 2 lakhs divided by 40, how many units will be allotted? 2 lakhs divided by 40, 5,000 units would have been allotted, correct? The value of 5,000 units today, the closing NAV is nothing but 5,000 units into 52 is how much? Okay, this is the value. Value comes to 2,60,000. Are you all understanding? So passive buy and hold strategy gives you a maturity value of 2,60,000, which is more than the this mechanism, which means in this case, in this question, okay, the passive buy and hold strategy gives a better return than the active balancing portfolio rebalancing strategy. Anyways, but question to question it may vary. Sometimes the passive strategy will be less efficient than the active strategy. You need to select the strategy. In this question they have not specifically mentioned which strategy is to be selected, but of course if question mentions you which strategy is to be selected, the strategy which gives you highest return you should select. Okay, with this we are closing the session mutual funds, and we will see in the next video forex exposure and risk management. We will try to cover forex or portfolio management. Thank you.